I think as we are sitting here this morning, the futures are up a little bit. We had a good Friday. We had a very
John
strange...
Williams had a good Friday.
He did. And look, I mean, anecdotally, it sounds like there are a fair number of people who wanted to take some time off this week that aren't getting it. So I think people are, at a minimum, are going to be cranky when they get back after December. But I think the reality is that there have been a lot of things causing stress in this market. Maybe not any single one of them enormous stress, but it all kind of adds up. I think the Fed was one of those, frankly, because we had seen expectations for cuts taken out. And when you've seen that happen in recent years, kind of going back to late 2022, that tends to trip up the stock market. And when we put cuts back in, it tends to help the stock market. So I have no idea what they're going to say. I know that RBC's rate strategist has been in the December skip camp, and then he thinks they resume next year. So my guess is the drama is not yet over. But we also know that valuations have been a problem since August. And we've seen, FY2 valuations sort of bumping up against ceilings. We're going to cycle into new earnings at some point. But right now, companies don't want to talk a whole lot about 2026. So I think
I don't think they want to talk about December.
I don't think so either. I mean, I will say, the consumer companies are coming up. We've got a few more this week. They're kind of trickling in. It was kind of hit or miss last week. There were some good ones. There were some not so good ones. It does seem like there are certain retailers who are winning with all cohorts of consumers that have more value-conscious offerings. So I think companies are still managing through pretty well, but this feels very unsettled, to be honest, coming back post-Thanksgiving.
So I know you guys at RBC have your 2026 outlook here. What are the themes that you're going to be focusing on for 2026?
So, we did sort of an early cut back in September of, this is what we're seeing for the second half, kind of a second half September type target. We haven't done, sort of here's the big burrito for, the one that everyone writes at the end of the year, partially because we had done that early one. But we had been saying 7,100 for sort of a mid to second half 2026 kind of number. And I would say our messaging hasn't changed, which was that we have thought for quite some time the market was way overdue for kind of a 5 to 10% garden variety type pullback. We finally crossed the 5% threshold on Thursday. That's very good news, because I'd rather get this out of the way now than have it overhanging the market early next year. And the way we've put it is we think stocks can do well next year, but we do think we have some stuff to work through to get there. And the good news is we finally started working through those things.
But we've got arguably strong earnings environment. Second and third quarter earnings were very, very good. We've got presumably a Fed that's in a easing mode. Are those two things in and of themselves enough to move the market higher, do you think?
Well, this is the interesting sort of part of the Fed conversation from an equity market perspective, right, which is, 2 or 3 more cuts, right? I mean, that's good and that's helpful, but it's not like we're at the beginning of something big and long-lasting if you look at most forecasts around the street. Right, this is kind of a modest adjustment cutting, type cycle that most folks are talking about. I do think earnings growth is extremely important. I think that's what's been powering markets.
Can you model it out for Q1 2026?
In the first quarter, I think that, I think January is going to be sort of a pivotal time, to be honest, Tom, when companies really kind of unveil the 2026 outlooks. And we keep seeing that in commentary, right? Analysts who dare to ask the question are getting brushed back, and companies are saying, we'll get back to you in January or February. I don't think anyone's really going to care, honestly, about 4Q results by the time January, February rolls around. Interesting.
Lori Calvasina, we continue with her with RBC Capital Markets. I went nerd early in the show. I'm going to do it again with the lawyer. Paul, can we go back to memories? John Malone, Tacoma. Remember T-C-O-M-A?
Yeah, darn right.
Okay, there was an invention, believe it or not, in the 60s. This didn't exist. Enterprise value to EBITDA. This weekend, I saw essays of this ratio of debt cash stock as compared to the income statement, somewhere in the income statement plus depreciation, amortization. Do you have a conviction that in the cacophony we're living now, you can use a modern ratio like EV to EBITDA?
So, it's funny, Tom, a number of years back, I actually surveyed all of my analysts about what valuation metrics they thought were appropriate for their industries. And I made them give me 2. And I did find that a lot of the tech-related analysts gave me EV-related metrics. That was really where it tended to be limited, to be honest. And then the thing that everybody sort of agreed on, it may not have been their first indicator. In fact, it usually wasn't their first indicator, but forward PE. Yep. So I tend to still be a forward PE person because I think when you're comparing industries, you're comparing sectors, you're comparing size segments, you need something that's more universally applicable.
All right, let's stay with the earnings theme here. Are the earnings strong enough to support this market and to drive it higher right now, do you think?
So, there's healthy earnings growth embedded in the consensus expectations for next year. When we've modeled it out, we haven't gotten quite as constructive as consensus, but we've still got, some healthy numbers, I think around like 10% or so. The reality, though, is that earnings sentiment matters just as much as the earnings themselves, and the rate of upward revisions for the broader market peaked in August. We don't have post-NVIDIA, sort of results yet. For that particular indicator that we look at, the rate of upward revision. So what I need to see in coming weeks is, as analysts go back and do like all their little modeling,
right,
and update all their numbers, do we surpass or return
right
to that August peak? And we just don't know the answer to the question yet. But I think one thing markets are struggling with is the idea that earnings sentiment, it's okay, it's just not as good as it was.
Interesting.